Christian B. Burnaby, Vancouver-based real estate agent. Welcome to Rapid Fire Real Estate, where I take you through a number of topics. We spend a few minutes on each, and you can take that intel out into the marketplace. And if you need more help, my contact is in the show notes below. Okay, big changes this Monday, September the 16th. The Ministry of Finance just announced two huge changes, and this is going to have a big impact. And the first is the down payment requirements have been brought way down. So we're going to touch on that. Second, amortization periods have been changed, and you need to know what it is. It's a boring word, but it has a big impact. And I'm going to give you the money math in a second. And the third is I just want to revisit using your RRSPs and using money from your first-time home buyer's savings account, and it's just some thinking, some considerations in case you are breaking, you've got an Excel spreadsheet out there and you're breaking out the math and trying to answer the question of, which account do I contribute first and so on. Okay, so the first thing I want to do is start off with the change in the down payment requirements. This is big, and here's why. What the government has done is they've raised the bar. Up until today, if you were buying $1 million property, you had to have 20% down, $200,000. They're going to raise that bar to $1.5 million, and anything below that is going to have less of a down payment requirement. And they must have been watching one of my videos, because I gave this exact recommendation earlier this summer on how to make things more affordable. But let's do some money math. Example, today, $1 million property, if you're buying it, you need a $200,000 down payment. With the change effective December the 15th, 2 weeks before Christmas, a Christmas present, you now only need $75,000 for that same, as a down payment for that same $1 million property. Let's play some more math. $1.25 million purchase. You're buying a townhouse on Burke Mountain. And again, it's new. It's maybe your first home purchase. Today, you need a $250,000 down payment. Effective December 15th, it drops less than half to just $100,000. So of course you need to qualify for the income with the bank, and they're going to put you through the ringer. But the down payment requirement is a much lower bar for you to jump now. And the issue in Vancouver is not so much that people don't have the income to qualify. The big bar to jump is always having the down payment. And that takes years of saving. Guys, it took me 7 years of working 400 to 450 Saturdays and Sundays in a row to save the down payment to get into a house. And I know it's not easy. I think I've lost some hairs in the process, and many have turned gray. But it just makes it easier on you guys now. If you're buying $1.499 million home, and that, again, this could be now a detached house in some of the bedroom communities surrounding Vancouver, like Langley, Maple Ridge, Delta even, and the surrounding areas of Surrey. You're looking at today a down payment of $300,000 with the change effective 2 weeks prior to Christmas, $125,000. Drastic difference. So this makes it so much easier for a huge cohort of Gen Xers and Gen Zers to climb into the market now. They have to have the income to qualify. And that is, of course, another question. But anyway, big change. Second thing, amortization has changed as well. Now, I said before in the intro, that's a boring word, but it's very important, and here's why. And this wasn't a recommendation. This was a suggestion I had in a video earlier this summer, which was if you lengthened the amortization to more people, you drop the monthly payment. So up to 1.5 million now, you can reduce your amortization, lengthen it to 30 years. What does that mean in dollars? What it means is that on $1 million mortgage, your payment would have been $5,600. It now drops by $500 at today's interest rates to $5,100. That's a $500 a month savings, $6,000 a year, $30,000 over 5 years. So that's that's really big. I think that's going to help a lot of people with the monthly payments bar that is very difficult to hurdle. So big changes. Again, they're saying it's effective as of December the 15th. In addition to, there's a few changes with the amortization for first-time home buyers. It now applies to all builds. It was pre-sales, but now it applies to resales as well. Okay. And when it comes to pre-builds, the 30-year amortization now is available to all buyers. So that's a big one too. So if you're buying a second or third property, you can also do that. And the reason the government is doing that, of course, is they want to encourage the construction industry, right? They want developments because we need housing, and this is one way to spur buyers to choose pre-sales instead of resales if everybody qualifies for that shorter monthly, lengthened amortization, but lesser monthly payments. Okay, so big changes. So say thank you to the Ministry of Finance. Now, a couple of changes that they didn't do, and these are, of course, inside the provincial jurisdiction of British Columbia, that I had recommended was, one, drop the property transfer tax for properties under $1 million. You save buyers $18,000 right there. And second was revisit the anti-flipping tax, which they brought in. That's a huge mistake because that's just a lose-lose for everybody, because now a buyer buys a property. They've put in their down payment. They've cleared out their RRSP, and now they still have to come up with the $80K, $100K to renovate the property. The bonus of the way it used to be was that, the flippers, Eric the electrician and his son Peter Plumber went in there. They fixed it up. They made a little bit of a profit. Not always. And in essence, the renovation was costed into the purchase and into the mortgage. So you didn't have to have the extra $80,000. Anyway, what I want to do is, last topic here I want to talk about today is the first-time home buyer savings account, RRSP. Sometimes I'm asked, where should you focus putting your money first? I think I talked to an accountant before making this video, and he had some suggestions. So it's a lot of what I'm saying now is his suggestions. Of course, it depends on your situation. We can't know it, so you should talk to your accountant. But in general, you would want to contribute to your first-time home savings account first, and you get $8,000 a year for 5 years. That's $40,000. Now, if you think about that, $40,000 is not a lot as in Vancouver and Toronto. So it's really meant for a purchase here in the next 3-4 years of your future. It's okay. And of course, it's tax-free in, it's tax-free out. The big benefit of this is it's kind of like the RRSP had a baby and called it the FTHS, is that you can deduct that from your taxable income. So you deduct $8,000 a year from your taxable income. On your RRSP, of course, the changes earlier this year were that you can now take out up to $60,000 per person out of your RRSP towards a down payment on your home. And if you're a couple, you can take out $120,000. And if you've put a little bit in your FHSA, you can combine that as well. So there's maybe your down payment right there. The considerations for this are, like one question I will get asked is, should we leave and maybe this is for a financial planner, but should we leave our money in our RRSP and just, use savings from a savings account? And I guess if you put up a an Excel sheet and you input some numbers and you played around with the math, if in the long run, you're probably better off leaving your money in the RRSP to let it snowball in a tax-free, tax-sheltered account. So for example, I was just playing with some numbers here. If you're doing really well at 10% per year, you had $60,000, you had it at 10, you're getting 10% a year, you're getting $6,000 in savings that you're adding through compounding growth. If you were to take that 60 out of your RRSP and then pay down your mortgage payment would be $250 at a 4% interest rate. Your mortgage would be $250 less. So over 12 months, that would be $3,000. So effectively, you'd be paying $6,000 to save $3,000. That doesn't make sense. It really depends, though, on what return you're getting in your RSP. If you're getting 7%, which is more conservative, it's probably a better number to use. You're still doing better over the very long run. We're talking, 15, 20 years. Then if you have the equivalent savings available for a down payment and you don't need the RRSP money. Okay. If you need it, well, then it doesn't really matter. You just take it out and withdraw it because you need a roof over your head, and maybe you want to start a family and have kids, and so that is a consideration. And I think we've covered the key parts. All right. The best thing to do is to see your RRSP or your FHSA, the money you're giving yourself, as an interest-free loan. From your RRSP, if you take $30,000 out, you do have to pay it back, and you have 15 years. So you just pay about $2,000, you just pay that back over the 15 years, and you're good, right? No interest to yourself. So hope that helps. Hope that puts some things in perspective for you. If you enjoyed the video, give us a like. I appreciate that. Thanks for tuning in, and we'll see you next time. Thanks.